Welcome to Currency Hacks.
He didn't announce it at a podium. He didn't tweet about it. He buried it inside an executive order on a Friday night, while silver was crashing 26% in a single day, and gold was having its worst session in over a decade. He buried it inside an executive order on a Friday night, while silver was crashing 26% in a single day, and gold was having its worst session in over a decade. But here's the part that should terrify you. That crash, that historic, violent, record-breaking crash, that was the signal. Not the warning, the signal. And by the time you understand what that executive order actually set in motion, you'll realize the dollar was never supposed to survive this. Let me explain. To understand what happened on January 30th, 2026, one must first understand what didn't happen. Because the most important financial decision of this decade was not made in front of cameras. It was not debated on cable news. It was not analyzed by a single mainstream financial outlet in real time. It was buried. On that Friday evening, while global markets were in freefall, while silver was plunging from a record high of $121.64 to below $80 in a matter of hours, while gold was recording its worst single-day decline since 2013, the Trump administration quietly released the results of a months-long review into whether foreign imports of critical minerals, including silver and platinum, posed a national security threat to the United States. The conclusion was stunning. Rather than imposing sweeping tariffs on silver imports, as the market had feared and priced in for months, the administration chose a completely different path. President Trump ordered Commerce Secretary Howard Lutnick to negotiate bilateral purchase agreements with foreign governments. He proposed setting price floors on imported critical minerals to protect domestic production, and he gave officials 180 days to report back. Now, on the surface, this looked like a retreat. Financial media framed it as Trump backing down. Silver dropped 7.3% on the headline alone. Traders read it as the removal of a tariff premium that had been baked into silver prices for months, but that reading missed something fundamental. The executive order didn't just skip tariffs. It reclassified the strategic importance of silver within the federal government's framework. By ordering price floor negotiations, by treating silver the same way the government treats oil in the Strategic Petroleum Reserve, the administration effectively acknowledged what physical market participants have known for years. Silver is not just a commodity, it is a strategic asset. And here is where the timing becomes critical. That same week, China had already made its own move. On January 1st, 2026, Beijing implemented a new export control regime on silver, reclassifying it from an ordinary commodity to a strategic material, placing it in the same category as rare earths. From that date forward, silver exports from China required government licenses, and those licenses were restricted to just 44 approved firms meeting strict criteria, including annual refined output of at least 80 tons and credit lines above $30 million. So within 30 days of each other, the world's two largest economies both moved to treat silver as a strategic national asset. One restricted exports, the other began negotiating price floors on imports, and the market crashed. That contradiction is not an accident. That contradiction is the signal, because when two rival governments simultaneously move to secure the same metal, while the paper price collapses, the question is not what went wrong with silver. The question is what went wrong with the price. The answer lies in what happened inside China's financial markets that same week. The UBS SDIC Silver Futures Fund, China's only public investment vehicle for silver futures, had been trading at a 36% premium over its net asset value. Chinese regulators halted trading in the fund twice. Once on January 22nd, and again on January 30th, the same day as the crash. The premium was so extreme that the fund's issuer had been sending near-daily risk warnings to investors. When trading was finally suspended, the forced reconciliation between the fund's inflated secondary market price and its actual net asset value sent shockwaves through global silver markets. U.S. Treasury Secretary Scott Bessent, speaking on February 10th, called it a speculative blow-off and explicitly blamed Chinese traders for the volatility. He described the trading activity as unruly and pointed to the leverage that had built up in Chinese retail and institutional accounts as the primary catalyst for the crash. But here is what Bessent did not say. He did not mention that while Chinese speculators were being flushed out of paper positions, physical silver premiums in Shanghai held firm. He did not mention that dealers in Singapore saw queues of buyers on Monday morning after Friday's bloodbath. He did not mention that vault inventories at the COMEX continued to decline during the very week that paper prices were collapsing. And he certainly did not mention that the executive order his own administration signed that Friday night was, in effect, an admission that the United States cannot secure enough physical silver at current prices. That is part one. A crash that was not a crash. A retreat that was not a retreat. And two governments racing to secure the same metal while telling their citizens not to worry. To understand why silver's crash was actually a signal for dollar weakness, one must follow the money. Not the headlines, not the tweets, the money. On January 30th, 2026, President Trump nominated Kevin Warsh to succeed Jerome Powell as chair of the Federal Reserve. Powell's term expires in May. If confirmed by the Senate, Warsh would take the chair at a moment when the Federal Reserve faces a set of contradictions that may be impossible to resolve. The initial market reaction was violent. Gold dropped 9%. Silver crashed 26%, its largest single-day decline in recorded history. The dollar surged. Investors interpreted the Warsh nomination as a signal that monetary policy would shift toward institutional orthodoxy, a stronger dollar, and tighter financial conditions. The inflation hedge trade appeared to collapse overnight. But within days, a very different picture began to emerge. Robin Brooks, a senior fellow at the Brookings Institution who had correctly predicted Japan's fiscal deterioration, published an analysis arguing that Warsh would not be hawkish at all. He predicted 100 basis points of rate cuts across the June, July, September, and October meetings, bringing the federal funds rate from 3.5%, 3.75% down to 2.5%, 2.75% before the November midterm elections. His reasoning was straightforward. Trump has made lower interest rates a centerpiece of his economic agenda. He publicly called for rates near 1%. He spent years attacking Jerome Powell. No nominee would survive in this administration without delivering rate cuts. As Brooks put it, Warsh's worst nightmare is probably to have Trump turn on him like he did on Powell. And there is the trap. Warsh has simultaneously called for shrinking the Federal Reserve's $6.6 trillion balance sheet, which consists primarily of Treasury bonds and mortgage-backed securities accumulated after the 2008 financial crisis and the 2020 pandemic. He has argued that these holdings distort the bond market and encourage the government to run large deficits. He wants the Fed's balance sheet smaller, much smaller. But here's the contradiction. If the Fed aggressively sells treasuries from its balance sheet, it increases the supply of bonds in the market. When supply increases, bond prices fall. When bond prices fall, yields rise. When yields rise, mortgage rates rise. When mortgage rates rise, housing becomes less affordable. And housing affordability is the other centerpiece of Trump's economic agenda. So the incoming Fed chair is being asked to cut rates, shrink the balance sheet, maintain price stability, support housing affordability, and preserve the independence of the institution, all at the same time. These goals are mathematically incompatible. The only escape valve is a weaker dollar. If rates are cut aggressively while the balance sheet shrinks, the net effect on financial conditions depends on relative speed. Cut rates faster than you shrink the balance sheet, and money stays loose. But loose money with high government spending and tariff-induced inflation pressures means the dollar loses purchasing power. And a weaker dollar means higher commodity prices, higher gold, higher silver. This is not speculation. This is arithmetic. The United States is currently running a budget deficit above 5% of GDP with no credible plan to bring it under control. The national debt is borrowing $43.5 billion per week. Interest payments on that debt are on track to exceed $1 trillion in 2026 alone, and the Congressional Budget Office projects they will reach $2 trillion per year by 2036. Every basis point of rate cuts reduces the cost of servicing that debt. Every year of delay makes the problem worse. The Federal Reserve is being placed in an impossible position. It must cut rates to keep the government solvent. It must maintain credibility to prevent a bond market revolt. And it must keep the dollar strong enough to prevent capital flight. The last time a president successfully pressured a Fed chair to keep rates artificially low, under Richard Nixon and Arthur Burns in the early 1970s, the result was the worst inflation in modern American history, peaking at 15% in 1980. Silver peaked that same year at $49.45 per ounce. Adjusted for real inflation, that price would be well above $150 today, and silver has already traded above $120 in January 2026. The dollar trap is closing. The Fed cannot tighten without breaking the housing market and the government's balance sheet. It cannot ease without weakening the dollar and igniting commodity prices. And it cannot stand still without being overrun by the deficit. Kevin Warsh is not walking into a central bank, he is walking into a burning building. And every exit leads to higher silver prices. While Washington debates interest rates and Wall Street debates Kevin Warsh's first press conference, something far more consequential is happening on the other side of the world. And it is happening in silence. China did not just restrict silver exports on January 1, 2026. It restructured how the metal moves through the global economy. The new regulations require government-issued licenses for any silver leaving the country. Only 44 firms qualified. Each must demonstrate annual refined output of at least 80 tons, maintain credit lines above 30 million, and pass national-level scrutiny. This is not a tariff. This is not a quota. This is a gate. And Beijing now holds the key. The implications are structural. China is the world's third largest silver producer and the largest consumer, accounting for more than half of global industrial silver demand, driven primarily by solar panel manufacturing, electric vehicle production, and semiconductor fabrication. When a country that consumes more silver than anyone else simultaneously restricts how much silver leaves its borders, the global supply chain doesn't adjust. It fractures, and the fractures are already visible. In the weeks before the January crash, Shanghai silver premiums climbed above $8 per ounce over London prices, the widest spread on record. Physical silver in Dubai was trading between $100 and $127 per ounce, while COMEX paper contracts showed prices in the 70s. These are not normal market conditions. These are not temporary dislocations. These are the early signs of a global silver market splitting into two separate pricing systems, one for paper and one for physical. Japan is facing its own crisis. The yen has weakened significantly against the dollar, making precious metals more expensive for Japanese investors. But rather than reducing demand, the weak yen has accelerated it. Japanese investors, facing negative real interest rates and a currency that has lost over 40% of its purchasing power against gold in the past year, are treating silver as a store of value. Meanwhile, Japan's own political instability, with early parliamentary elections potentially being called in February amid domestic unrest and concurrent tensions with China, has added another layer of uncertainty that traditionally supports precious metals demand. But the most significant development is not happening in any single country. It is happening between countries. Emerging market central banks have begun accumulating silver through what analysts describe as shadow buying, acquiring metal through third-party entities, sovereign wealth funds, and non-transparent channels, rather than through formally announced reserve programs. The strategy is obvious. Avoid the headlines. Avoid moving the market. Build reserves quietly while the price is suppressed by paper market volatility. Estimates suggest that from the second half of 2025 into early 2026, emerging market central banks may have acquired several 100 million ounces of silver through these routes. Saudi Arabia has reportedly begun accumulating silver through ETFs, building a store of value that is harder for Western institutions to freeze and is backed by real industrial utility. This is the development that connects Trump's executive order to China's export ban to the dollar's vulnerability. When governments stop treating silver as a commodity and start treating it as a monetary reserve asset, the entire valuation framework changes. Silver is no longer priced on industrial supply and demand alone. It is priced on strategic scarcity. And the scarcity is real. The silver market has been in a structural physical deficit for 4 consecutive years. Industrial demand, particularly from the solar sector, continues to grow. Solar installations globally are consuming more silver than ever, and each new generation of photovoltaic cells requires higher silver loading to improve efficiency. The AI infrastructure boom has added another demand layer, as data centers require massive amounts of silver for high conductivity connections and thermal management. Meanwhile, mine supply has been essentially flat. The largest silver producers, Mexico, Peru, China, Australia, and the United States, have not significantly expanded production, despite a price increase of over 150% in the past year. Mining companies, burned by previous boom-bust cycles, have been slow to commit capital to new projects. The lead time from discovery to production for a new silver mine is typically 7 to 10 years. Even if every mining company in the world approved a new silver project tomorrow, the supply response would not arrive until the early 2030s. So the math is simple. Demand is rising, supply is flat. Governments are hoarding, exports are restricted, and the paper market, which has historically set the price, is being progressively disconnected from physical reality. The East is not just buying silver. It is building a parallel pricing system, and that system does not answer to COMEX. It answers to physics, to industrial necessity, to strategic reality, and physics does not negotiate. Every signal described in the previous 3 parts, the executive order, the Warsh nomination, China's export controls, the physical paper disconnect, the deficit spiral, and the Eastern accumulation, these are not separate events. They are the same event viewed from different angles, and they are converging toward a single outcome that most market participants are not prepared for. Let the timeline speak for itself. January 1st, 2026. China implements export controls on silver, reclassifying it as a strategic material alongside rare earths. 44 firms receive licenses. The rest of the world's access to Chinese silver is now controlled by Beijing. January 15th. Trump's critical minerals review concludes. Silver is exempted from tariffs but placed into a new framework of price floor negotiations and bilateral purchase agreements. The administration signals that it views silver as essential to national security. January 22nd. The UBS SDIC Silver Futures Fund in China is halted for the first time, trading at a 36% premium over its net asset value. Chinese regulators issue the first of what will become near-daily risk warnings. The speculative pressure is building beyond containment. January 29th, silver reaches an all-time high of 121.64 per ounce. Gold touches $5,500. Shanghai premiums hit $8 over London. Physical dealers across Asia, the Middle East, and Europe report unprecedented demand. German customers queue for hours outside bullion shops. The world's largest silver ETF, the iShares Silver Trust, sets a new record above $47.5 billion in assets. January 30th, the crash. Silver plunges 26% in a single day, its largest drop in recorded history. Gold falls 9%, the worst since 2013. The UBS SDIC fund is halted again. 4 Chinese oil funds are simultaneously suspended. CME Group has already raised margin requirements 6 times. Trump nominates Kevin Warsh as Fed chair. The dollar surges. February 2nd, markets reopen. Analysis emerges suggesting Warsh will cut rates by 100 basis points before midterm elections. The hawkish narrative begins to crumble. Silver stabilizes around $80. February 5th. Silver drops to $70 intraday before snapping back to $78. Volatility reaches levels not seen since 1980. Trading desks report that the over-the-counter market is barely functional. Banks are struggling to hold positions on either side. February 10th. Treasury Secretary Bessent calls it a speculative blow-off and blames Chinese traders. Silver recovers to $82. U.S. retail sales data shows consumer spending has stalled. The GDP control group prints negative. Markets begin pricing in additional rate cuts. February 12th. Today. Silver trades at approximately $85. Gold approaches $5,100. The dollar index is weakening again. And the delayed January jobs report is about to be released, with a weaker than expected reading likely to accelerate the precious metals recovery. Now step back from the timeline and look at the pattern. 2 governments secured silver as a strategic asset within 30 days of each other. The paper market crashed precisely when the physical market was tightest. The crash was blamed on speculators, not on the structural deficit that created the speculation in the first place. A new Fed chair was nominated, who faces an impossible set of contradictions that all resolve in the same direction: a weaker dollar and higher commodity prices. And the delayed economic data is confirming what the metals market already knew. The economy is softening and the Fed will have to cut. JP Morgan's global research team projects silver will average $81 per ounce in 2026, more than double its 2025 average. But that projection was made before the crash, before the recovery, before Warsh, and before the full weight of China's export restrictions hit the physical market. Multiple analysts now see silver testing $150 to $200 if the structural deficit persists, and the Fed enters an aggressive cutting cycle. The crash from $122 to $70 was not the end of the silver story. It was the shakeout. The 1980 playbook, the Hunt brothers replay: force the weak hands out, raise margins until the underfunded capitulate, then rebuild the position at the bottom. And someone did buy the bottom. While retail investors were panic selling on January 30th, vault inventories were being drained. While paper prices collapsed, physical premiums held. While the headlines screamed crash, the institutional money moved. Trump's secret signal was never a press conference or a tweet. It was an executive order that treated silver as a strategic national asset, while the rest of the world was distracted by the largest single-day crash in the metals history. China's signal was an export ban that fragments the global supply chain. The Fed's signal is a nomination that makes rate cuts inevitable and dollar weakness a mathematical certainty. 3 signals, 3 governments, 1 direction, silver soaring, dollar crashing. It's not starting. It already started. And by the time the next headline catches up to what the physical market already knows, the window will be closed. The only question left is not whether silver will reach new highs. The question is whether you understood the signal before everyone else did.
Welcome to Currency Hacks.